Something important is happening inside the US banking system, and most investors still think it's business as usual. But if you look closely at what Warren Buffett is not doing right now, the warning becomes impossible to ignore. Because banking crises never start with headlines or panic. They start quietly, while confidence still looks normal, while people still believe their money is safe, and while risk quietly builds beneath the surface. Buffett has lived through every major banking disaster of the last half-century. He's seen banks fail in the 1970s, the 1980s, and in 2008. And every time, the pattern was the same. The danger wasn't everywhere. It was concentrated in a specific type of bank that looked fine, right until it collapsed. And that's exactly what makes this moment dangerous. The largest banks are not the real concern. Systemically important giants are built to survive stress. The real risk is hiding in a smaller corner of the market, banks exposed to rising rates, fragile deposits, and balance sheets that crack under pressure. As crisis risks rise, Buffett isn't making noise. He's simply avoiding certain banks altogether. And that silence tells you more than any headline ever could. In this video, I'm going to break down the 3 types of banks that history shows are the first to fail in moments like this, why they're uniquely vulnerable right now, and the simple warning signs beginners can watch for before losses spiral out of control. But before we get into which banks matter and why, you need to understand one uncomfortable truth about how banks actually fail. Because once you see it, the risk becomes obvious. Let's start there.
Bank stocks are fundamentally different from normal companies, and understanding these differences is crucial for any investor, especially beginners. Unlike typical businesses that sell products or services, banks primarily deal in money. They borrow money from depositors and lend it out at a higher interest rate, making a profit on the spread. This business model, while seemingly simple, introduces unique risks. One major difference is leverage. Banks operate with significantly higher leverage than most other industries. A typical bank might have a debt-to-equity ratio of 10-to-1 or even 20-to-1, meaning for every dollar of equity, they have $10 to $20 in debt. This high leverage amplifies both gains and losses. In good times, it can lead to impressive returns. But in bad times, even a small decline in asset values can wipe out a substantial portion of their equity, leading to insolvency. Another critical difference is regulatory oversight. Banks are heavily regulated due to their systemic importance. Regulators impose strict capital requirements, liquidity rules, and stress tests to ensure stability. While this oversight provides some protection, it also means banks operate under constant scrutiny and can be subject to sudden policy changes that impact profitability. The too big to fail concept also plays a role. Large banks are often considered essential to the financial system, leading to government bailouts during crises. While this might seem like a safety net, it can also encourage excessive risk-taking, knowing that the government might step in. This moral hazard can make it difficult to assess the true risk profile of a large bank. Furthermore, bank assets are often opaque and illiquid. Unlike a manufacturing company with tangible assets like factories and machinery, a bank's assets are primarily loans and other financial instruments. The true value of these assets can be difficult to ascertain, especially during economic downturns when loan defaults rise. This opacity makes it challenging for investors to accurately evaluate a bank's balance sheet. In conclusion, while bank stocks can offer attractive dividends and growth potential, their unique characteristics, high leverage, heavy regulation, systemic importance, and opaque assets, make them fundamentally different and often more dangerous investments, especially for beginners. Always conduct thorough due diligence.
The first and most dangerous category is regional banks with heavy commercial real estate exposure. Office buildings across the United States are not going through a normal downturn. They are going through a structural collapse. Remote and hybrid work permanently reduced demand. Vacancy rates are near historic highs in major cities. And the old assumption that demand will eventually come back is no longer reliable. Now connect that reality to banks. During the low-rate era, property owners borrowed aggressively. Regional banks funded those loans because they offered higher yields. Some banks ended up with 30, 40, even 50% of their loan books tied to commercial real estate. Those loans are now resetting. Property values are lower. Rental income is weaker. Interest rates are much higher. For many owners, the math no longer works. so they walk away. And every default forces banks to absorb losses, losses that directly eat into capital. Once capital weakens, depositors get nervous. Deposits leave. Assets are sold at losses. Confidence collapses. That's not theory. That's how bank failures actually happen. If a bank has more than 20% of its loans in commercial real estate, that's a red flag. Above 30%, it's a danger zone, especially when that exposure is concentrated in office buildings in major urban centers. The second dangerous category is banks with concentrated deposit bases. Banks don't usually fail because loans go bad overnight. They fail when deposits leave faster than assets can be sold. And in the digital age, money moves instantly. If most of a bank's deposits come from a single industry, a single customer type, or large uninsured accounts, behavior becomes correlated. Everyone gets nervous at the same time. Everyone pulls money at the same time. That's how banks that look healthy collapse in days, sometimes in hours. This risk is especially high for banks that primarily serve technology startups, crypto-related businesses, cannabis companies, entertainment industries, or wealthy private clients with large uninsured balances. When confidence cracks, deposits don't drift away. They vanish. And once a bank run starts, it feeds on itself. That's why deposit composition matters far more than most investors realize. High uninsured deposits don't just increase risk, they accelerate failure.
The third category is harder to spot, but often the most decisive. Weak management. Good bankers are conservative by nature. They worry constantly about what can go wrong. Bad bankers chase growth, market share, and short-term returns. Here's what separates the survivors from the victims: experience through downturns, conservative credit standards, strong capital discipline, transparent communication, and incentives aligned with long-term survival, not quarterly bonuses. Banks don't fail only because conditions worsen. They fail because management reacts badly when conditions change. Some try to grow their way out of trouble. Some hide losses. Some delay hard decisions. And by the time capital finally runs out, it's already too late. In banking, management quality doesn't just influence performance. It determines survival.
The most dangerous banks are the ones that combine all three risks: heavy commercial real estate exposure, concentrated and uninsured deposits, weak or inexperienced management. That combination is lethal. Losses weaken capital. Deposits start leaving. Assets are sold at losses. Confidence collapses. And once that spiral begins, shareholders are already too late. That's why banking crises always feel sudden. They're not sudden. They're ignored until the final trigger hits. So what should you actually do as an investor right now? First, if you own bank stocks, review them honestly, not emotionally. If a bank shows heavy exposure to commercial real estate, relies on concentrated or unstable deposits, or is run by management that sounds more promotional than conservative, that's not a value opportunity. That's fragility. And protecting yourself is not weakness, it's discipline. Second, never assume that cheap means safe. In banking, book value can vanish fast once losses are recognized. A stock that looks inexpensive can still go to zero if confidence breaks. That's why experienced investors don't hunt for bargains during banking stress. They avoid permanent loss. Third, if you want exposure to banks at all, focus on strength, not speculation. Large, diversified institutions with strong capital and stable deposits are built to survive stress. And if you're unsure, it's completely valid to step back. With interest rates still high, cash and short-term treasuries offer something extremely valuable: safety, flexibility, and patience. Remember this: you don't need to be aggressive to build wealth, but you must avoid mistakes that permanently take you out of the game. Bank failures don't offer second chances. Protect your capital first. Opportunities always come later. If this helps you think more clearly about risk, subscribe to Mac Invests.